All right, everyone, we need to talk about what's happening right now in the precious metals market because this is not normal. Silver just dropped another 5.21% today. It's sitting at $80.71. Gold crashed 4.09%. That's over $200, down to $46.89. Combined, we're looking at over $200 in losses across both metals just today. And this isn't a one-day event. This is day 4 of the most violent precious metal sell-off I've seen in my entire career. But here's what mainstream media isn't telling you. This wasn't organic selling. This was a forced liquidation event triggered by 2 specific decisions made over the past 72 hours. And what happens next, whether this is capitulation or the start of something worse, comes down to understanding what actually caused this collapse. Let me show you what your portfolio just went through. If you were holding 100 ounces of silver at the peak in January, when it hit 121.67, that position was worth $12,167. Today at 80.71, that same position is worth $8,071. You just lost $4,096. That's a 41% haircut in less than a month. Gold holders aren't much better off. If you bought at January's peak above 5,100 and you're still holding at 46.89 today, you've watched over $400 per ounce evaporate. But here's the part that should concern you more. If this selling continues, if we break the technical levels being tested right now, silver could drop to $70. That would put your 100-ounce position at $7,000. You'd be down over $5,000 from the peak. Now, those who saw this coming, who understood the structural vulnerabilities in this market, their situation looks completely different. The smart money wasn't buying at 120, they were selling. And now, according to JP Morgan's analysis published just 8 hours ago, those same institutions are preparing to accumulate at these lower levels because they see something the panicking retail investors don't. Something bigger is happening beneath the surface. Let me show you the 3 things that converged over the past 4 days. First, Kevin Warsh's nomination as Federal Reserve Chair. On Friday, January 30th, President Trump officially nominated Kevin Warsh to replace Jerome Powell as the next Fed chair. Markets reacted immediately. Within hours, precious metals began their historic plunge. Why? Because Warsh is viewed as a hawk, someone who will prioritize a strong dollar and keep interest rates elevated if inflation persists. He's known as a respected, independent central banker who won't bend to political pressure. The entire precious metals rally from 2025 through January 2026 was built on one narrative: currency debasement. Investors believed central banks would keep printing money, dollars would weaken, and gold and silver would protect purchasing power. Warsh's nomination killed that narrative instantly. The dollar index surged over 10%. When the dollar strengthens, dollar-denominated commodities like gold and silver become more expensive for foreign buyers. Demand drops. Prices collapse. Silver dropped 30% on Friday alone. Gold fell nearly 10%. Those were the biggest single-day losses since 1980. Second, CME margin requirement increases, not once, but twice. Here's where it gets technical, but stay with me because this is the part Bloomberg isn't explaining clearly. When traders buy gold and silver futures contracts, they don't pay the full value up front. They post margin, a percentage of the contract's value as collateral. The rest is leverage. On January 30th, the same day as the Warsh announcement, CME Group raised margin requirements. Gold margins increased from 6% to 8%. Silver margins jumped from 11% to 15%. That doesn't sound like much. But when you're leveraged 10 to 1 or higher, a margin increase means you need to deposit more cash immediately, or your broker liquidates your position. Thousands of traders got margin calls. They couldn't meet them. Forced selling began. Then, just 72 hours later, today, February 2nd, CME announced a second margin hike, effective after the close. Silver margins are now at 15%. For high-risk profiles, 16.5%. This created a cascade. Traders who barely survived Friday's margin call now face another one. More forced liquidations, more selling pressure. Prices drop further, triggering stop losses and more margin calls. It's a death spiral. Third, the structural setup that made this possible. Silver had rallied 71% through January. It hit an all-time record high of 121.67. Gold surged to over 5,100. These were parabolic moves driven by speculation, leverage, and momentum chasing. When you see moves that steep, that fast, you're looking at crowded positioning. Everyone's on the same side of the trade. Retail investors piled in at the top, buying the breakout. Hedge funds layered on leverage. Physical premiums spiked as dealers couldn't keep up with demand. But institutions, the real money, they were watching something else. They saw the futures market open interest expanding to extreme levels. They saw speculative positioning at multi-year highs, and they knew what happens when leverage gets this stretched. All it takes is one catalyst. Warsh provided that catalyst. CME's margin hikes provided the execution mechanism, and the crowded positioning ensured the violence of the move. These three factors didn't happen in isolation. They collided. And the result is what you're seeing today. A market-enforced liquidation, testing critical support levels, with traders asking the same question you are. Is this over or is this just beginning? So I pulled up the charts this morning, and here's what jumped out at me. Silver opened Monday around $76. It briefly recovered to $85 before getting slammed back down to today's close at $80.71. That's a $15 intraday range. Massive volatility that tells me we're still in panic mode. The key technical level I'm watching is $75. That's where silver found support briefly on Friday before bouncing. If we break below 75 and hold there, the next support doesn't come until $70. That's another 13% drop from here. Gold's critical level is 4,400. It tested that Friday, hitting a low of 44.04 before recovering. Today we closed at 46.89. We're still above support, but barely. If we lose 4,400, the next level is around 4,200. That would represent another 5% decline. The Relative Strength Index, that's a momentum indicator traders watch. It's showing oversold conditions on both metals. Historically, when RSI drops this low this fast, you either get a relief rally or you're in the early stages of a regime change. We're about to find out which one this is. Trading volume today was absolutely massive. This tells me we're not dealing with low liquidity panic. This is real money changing hands. Institutions are selling into the panic, but other institutions, like JP Morgan, based on their research, are positioning to buy. This reminds me of March 2020 when gold crashed from 1,700 to 1,450 in a matter of days. Everyone thought the bull market was over. Within 6 months, gold was at 2,000. The crash was forced liquidation, not a fundamental breakdown. The critical level I'm watching now is $80 for silver and 4,600 for gold. If we hold these levels through the end of this week, it confirms we're building a bottom. If we break them, we're testing lower levels, and this becomes a much longer correction. Now let's talk about the fundamentals, the real supply and demand picture. Global silver demand hit 1.2 billion ounces in 2025, according to the Silver Institute. That's up 8% year over year. This is being driven by industrial applications that aren't going away just because speculators got wiped out. The big three are solar panel installations. Silver is essential for photovoltaic cells, and the green energy transition is accelerating. Electric vehicle production, EVs use twice as much silver as traditional cars. And defense systems, missiles, radar, electronics all require significant silver content. On the supply side, global mine production hit around 880 million ounces last year. Total demand was over 1 billion. That leaves us with a structural deficit of about 150 million ounces per year. This deficit isn't caused by speculation. It's caused by industrial consumption permanently removing silver from the market. Here's the critical part. About 70% of silver comes as a byproduct of copper, zinc, and lead mining. When those operations slow down, which is happening now because of weak base metal prices, silver supply gets squeezed. Miners can't just produce more silver when prices rise. It's economically tied to other metals. Now the dollar just surged 10% in the past week. That's the strongest move in years. This signals the Federal Reserve, under potential Warsh leadership, will maintain tight monetary policy. When the dollar strengthens this aggressively, commodities typically struggle in the short term. But let me put this in perspective. Central banks added 850 tons of gold in 2025. China's People's Bank bought gold for 14 consecutive months through December. They were buying at much higher prices than today. They're not panic selling. They understand the long-term monetary picture. We're talking about institutional demand that views gold as strategic reserves, not trading positions. That demand doesn't disappear because speculators got margin called. Smart money saw this coming. Central bank gold purchases hit 850 tons in 2025, according to the World Gold Council. That's the second highest on record. China's central bank added gold for 14 straight months through December. Russia, India, and Poland increased holdings despite gold trading above $4,800. Now here's what today's move revealed about institutional positioning. According to Bloomberg, silver ETF outflows were massive on Friday. During silver's rally from $30 to $121 over the past year, fund holdings grew by hundreds of millions of ounces. That positioning is now unwinding violently. Let me break down what this means. Speculators who bought silver above $100 are capitulating. They're taking catastrophic losses. Hedge funds that levered up are being forced out by margin calls. The weak hands are gone. But here's the interesting part. Retail investors and institutions are doing opposite things right now. Retail is panic selling. According to dealer reports, physical silver premiums collapsed over the weekend. Coins that were selling at $5 premiums are now at $1. That's retail liquidating into fear. Institutions, meanwhile, are preparing buy orders at lower levels. JP Morgan's research desk, just hours ago, issued a $4,600 gold target by year-end 2026. They're not panicking. They see discounted entry points. I want to share something Greg Chernow, portfolio manager at PIMCO, said last week. He called this a violent unwinding of crowded trades, not a fundamental breakdown. And producers, the mining companies actually pulling this metal out of the ground, they're not slashing production. They're locking in sales at current prices because they know their costs are half of spot prices. They're not panicking. They see the real supply and demand picture. Speculators reduced net long positions by over 30% in the week ending January 31st, according to CFTC data. They still hold significant long contracts. For context, at the peak in 2011, net longs were twice current levels. So we're not at extremes yet in terms of positioning. Today, flushed out the leveraged momentum chasers. What remains are long-term holders and value buyers. And if history is any guide, forced liquidation events like this create the best buying opportunities for patient capital. We've seen this exact pattern before. Back in March 1980, silver experienced something remarkably similar to what we're seeing today. Let me walk you through how it played out, because the parallels are striking. Stage 1, the parabolic rise. Silver rallied from $6 in January 1979 to over $50 by January 1980. That's an 800% move in 12 months. It was driven by the Hunt brothers' attempt to corner the market, inflation fears, and Soviet invasion of Afghanistan. Sound familiar? We just saw silver rally 71% in less than a year, driven by currency debasement fears and speculation. Stage 2, the margin hike trigger. On January 21, 1980, COMEX, the predecessor to CME, raised margin requirements dramatically. Just like this week, they increased the amount of cash traders needed to hold positions. Silver crashed from $50 to $11 in a matter of weeks. That's a 78% collapse. Compare that to today. We've dropped 41% from 121 to 80. Similar mechanism, similar violence. Stage 3, the bottom formation. After the crash, silver stabilized between $10 and $12 for several months. Physical buyers stepped in. Speculators were wiped out. The market found equilibrium based on actual supply and demand, not leverage and speculation. We're potentially entering this phase now. Stage 4, the long recovery. Silver eventually recovered to $16 by late 1980, then spent years in a range before the next major bull market began in 2003. The complete journey took time, but those who bought the panic made significant returns. Where we are now, right now in 2026, I believe we're somewhere between stage 2 and stage 3. The forced liquidation is happening. Leverage is being destroyed. The question is whether we've hit the capitulation point or if there's more pain ahead. Let me compare 1980 to today. Peak price, $50, then versus $121.67 now. Trigger event, COMEX margin hike, then versus CME double margin hike now. Percentage move, 78% crash, then versus 41% so far now. Key support level, $10, then versus $70 to $75 now. Based on historical timing, it took about 3 weeks from the initial margin hike for silver to find a bottom in 1980. We're currently on day 4. That puts our expected window somewhere between mid to late February. If this plays out proportionally, 1980 saw a 78% decline from peak. The equivalent today would be a drop to around $27. That seems extreme and unlikely given the structural supply deficit we have now that didn't exist in 1980. A more conservative estimate would be a 50 to 60% retracement, putting us in the $60 to $70 range for silver. But here's the key difference. In 1980, there was a massive supply overhang and no structural industrial demand. Today, we have a 150 million ounce annual deficit and irreversible industrial consumption. This works in favor of bulls because the fundamental floor is much higher. However, 1980 didn't have algorithmic trading, ETF liquidation mechanics, or global interconnected markets that can amplify moves. Today's context is structurally more volatile in the short term. The pattern doesn't repeat exactly, but the sequence and psychology remain remarkably similar. Euphoria, leverage, margin hikes, forced liquidation, capitulation, and then, for those still standing, recovery. Here's what this means for your money. Let me show you what this actually means in real dollars. If you're holding a traditional 60-40 portfolio, 60% stocks, 40% bonds, here's what happened over the past week. Stocks dropped about 2% on the commodities route spillover. Bonds gained about 1% as investors fled to safety. Combined on a $200,000 portfolio, you're down roughly $1,000. Now, if commodities continue to unravel, if silver drops to $70 and gold falls to $4,200, here's what happens. Commodity-exposed stocks drop another 5%. Your stock allocation loses another $6,000. Gold mining stocks, which many investors hold for diversification, they've already fallen 20 to 30%. On a $10,000 position in miners, you're looking at $3,000 gone. The contrast. Now, those who positioned correctly, who held physical metals accumulated at lower prices, who avoided the leverage trap, who didn't chase the breakout above $100, their situation looks very different. They're sitting on gains from the $40 to $60 range. Even at $80 today, they're up 30 to 50% on core positions. They can afford to ride through this volatility. Institutions like China's central bank accumulated at much lower levels. They're not margin called. They're not panicking. They're watching and waiting. Here's why I'm telling you this. The window has just opened. Not because I know $80 is the bottom. I don't. Nobody does. We might go to 70 first. The window matters because of the structural picture. The industrial demand deficit is irreversible. Every solar panel installed removes silver permanently. Every EV produced locks in 40 to 60 grams of silver for 20 years. This isn't speculative inventory sitting in a warehouse that can flood back to market. It's physical metal in a solar panel on a roof in California or a circuit board in a Tesla for decades. I've been tracking this market since 2008, and I've never seen margin hikes this aggressive while the fundamental supply-demand picture remains this tight. That combination creates pain in the short term but opportunity for patient capital. Look, the question isn't whether we see more volatility. The data is clear. We're going to see continued wild swings until leverage is completely flushed from the system. The real question is, are you positioned for what comes next? In every previous crisis, 2008 financial collapse, March 2020 COVID crash, every forced liquidation event, hard assets preserved purchasing power while financial assets eroded once the dust settled. The trick was surviving the panic and positioning during the chaos. Right now, silver sits at 80.71. Gold sits at 46.89. The next 2 weeks determine whether this was capitulation or the start of a deeper correction. I share real-time updates and deeper analysis on social media. For those wanting exclusive research and members-only analysis, there's a premium level. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. But the pattern tells the story, and what happens next will separate those who understand market structure from those who trade headlines. All right, before you go, 3 quick things. 1. Drop a comment below. Tell me where you're watching from, and give me your prediction. Where do you think silver is headed by the end of February? $70? $60? Back to 100? I want to hear your take. 2. If you're not subscribed, hit that button now. I'm putting out unfiltered analysis 3 times a week. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment data over hype, so the algorithm knows you're here for the original. 3. Next video drops tomorrow morning. I'm covering the one indicator that predicted 2008. It's flashing again. Last time this signal triggered, gold dropped 15% before rallying 60%. You won't want to miss it. See you there.